Good morning and welcome to Gough Square Live. We hope you had a lovely Easter weekend. So here we are, 1 week after the FCA published its much anticipated motor finance redress scheme. After spending those 7 days feverishly analysing its 584 pages in a windowless room in Chambers, Jack Brady and I have finally been allowed out by the clerks, blinking in the sunlight. No doubt many of you watching have also been wading your way through the document, and even for the very brave, the technical annexes and the diagnostic report. This morning, Jack will provide an analysis of the mechanics of the scheme and likely challenges to it. Before that, I will set out the background by way of a short retrospective of the 2 decades long and ultimately very expensive journey of motor finance regulation. So let's begin with a couple of headline points about 26.3. Its scope is considerable: 12 million agreements, more than a fifth of the UK adult population, and a likely £9 billion total cost. So how did we get here, and how did this end up costing so much? Arguably it's happened because of a combination of a regulatory regime in place for many years, which was at best unclear in what it required of those selling motor finance, and regulators who were slow to react. They took years to decide there was a problem and do something about it. If we start back in 2007, when the unfair relationship jurisdiction came into being, the commission models at the heart of the issue, DCAs, were already widespread. In fact, as noted in the technical annex of PS 26.3, increasing DICs were particularly prevalent. Instead of the conc rules, there was guidance, but the basic thrust was the same. The OFT said that in appropriate circumstances, the existence of any commission should be disclosed, and the amount, if requested by the borrower. But nothing clear was said about disclosing the model of the commission. So already trouble was brewing. There was widespread use of DCAs combined with guidance which, in retrospect, was not entirely clear, certainly if you're looking for a requirement that the broker should disclose how commission was calculated. You might ask, was the OFT an active regulator monitoring this situation, providing guidance to firms that they might be risking non-compliance? Well, the short answer is no. A 2013 report by Parliament's Public Accounts Committee, which was entitled Regulating Consumer Credit, criticised it for being ineffective and timid. And what about the complaints to the FOS? Was a warning being sounded there that firms might be breaching their obligations and sitting on a regulatory time bomb for the future? Again, no. A 2009 FOS newsletter focusing on complaints about motor finance did not even mention commission. Then in 2013 and 14, the FCA took over regulation of consumer credit. It deliberately sought to transpose the guidance into its new scheme of rules. This had the benefit of limiting changes which industry had to address. But the downside was that any ambiguity about what precisely the regulator wanted continued under the new regime. It was not until 2017 that the FCA began to conduct a diagnostic review of the motor finance market. It eventually found that DCAs created a conflict of interest, leading to higher costs for consumers. It's worthwhile noting that DCAs were not deemed to be universally pernicious, although you might not think that from the way the current scheme is drafted. Because, of course, they do give the broker a discretion, and sometimes that could be used to actually reduce the cost of the finance being provided to the consumer below the market rate. That would be done to get the deal over the line. But the FCA decided that harm was being caused in many cases, and crucially, additional disclosure requirements probably would not be sufficient to ameliorate the harm. And so, finally, in January 2021, the FCA introduced a ban in respect of discretionary commission arrangements in motor finance. It also amended provisions applying outside of that kind of finance, in particular to disclosure rules 4.53 and 3.74G. The FCA's position now, as expressed in the Clydesdale JR and in Johnson, is that these were not really changes of substance. They were, as the FCA would put it, clarificatory. In other words, the FCA says the rules all along required disclosure of the nature of a DCA arrangement, even though the part most clearly dealing with commission, rules 4.53 and 4.54 in particular, did not actually say that. So here we find ourselves. Lenders and dealers might have been forgiven for applying the commonsensical rule of interpretation that where a scheme makes express provision for a particular matter, a more general provision in the same scheme will not be construed as intended to cut across or override the specific provision. In Latin, that is, of course, Jack, generale specialibus non derogant, as everyone knows. So in 2021 to 2022, with the ban on DCAs, we started to see significant numbers of county court claims involving motor finance appearing. And I'm sure you're all familiar with the rest of the story. Johnson appeared in the Court of Appeal in 2024 and the Supreme Court in 2025. And then the consultation took place from late last year, leading to this redress scheme. So with that summary of how we got to an enterprise which is going to cost £9 million, I'll hand over to Jack to describe some of the key features in more detail.
Thanks very much, Richard. So let's have a look at the scheme itself. Richard has, of course, taken us to last Monday when, just after markets closed, the FCA published its 584-page policy statement. The statement explained that the FCA will go ahead with facilitating consumer redress, which came as little surprise, but that this will take place through two schemes, one covering credit agreements dated between the 6th of April 2007 and the 31st of March 2014, and another covering credit agreements between the 1st of April 2014 and the 1st of November 2024. The policy statement goes on to outline how those schemes will operate, which is worth reviewing as there are some differences to the proposed scheme in the FCA's consultation paper. The headline, as Richard said, is that the estimated redress and administration costs for firms has reduced from £11 billion to £9.1 billion due to fewer agreements qualifying under the published schemes than at consultation stage. That is, in part, due to some limited changes to the relevant arrangements, i.e. the arrangements the FCA considers are strongly associated with an unfair relationship, and which could result in an unfair relationship if not disclosed. In the published statement, there remains a presumption that the relationship between a consumer and a lender was unfair where there is inadequate disclosure of the following relevant arrangements. First, a discretionary commission arrangement, a DCA. Second, a high commission arrangement. And third, where there is a contractual tie between a dealer and a lender, giving the lender exclusivity or first right of refusal over the finance business. There is no change to the definitions of a discretionary commission arrangement or tied arrangements, but the FCA has revised its threshold for a high commission arrangement from commission at 35% of the total cost of credit, 10% of the total amount financed, to at least 39% of the total cost of credit and 10% of the amount financed. Relatedly, new exclusions from the relevant arrangements have also caused the headline redress figure to reduce. In the following scenarios, consumers are now not entitled to redress through the schemes. First, where the commission paid is below a de minimis threshold, which is £120 for the first scheme and £150 for the second scheme. No such threshold was proposed in the FCA's consultation. It now applies regardless of the existence of any relevant arrangements. Second, where the APR on the credit agreement was zero, again regardless of whether there are any relevant arrangements, on the basis that in such a case a consumer would not have been interested in shopping around to obtain a lower APR, so it's likely that there would have been no conceivable impact on their decision making. Third, where discretionary commission arrangements, but the dealer did not act upon those discretionary commission arrangements. This will be the case when the dealer selected the lowest of interest in the range of available interest rates. This is a point that was raised in the consultation as a ground for rebutting unfairness, but is now an exclusion from the DCA relevant arrangement. And fourth and finally, in respect of tied arrangements, arrangements that are captive or white label tied arrangements fall outside of the schemes, where information was available that made it reasonably possible for a consumer to appreciate that there was a significant commercial relationship between the dealer and the lender. Rather than being an automatic exception, firms will need to show a practice of prominent branding and the use of their trading name on dealership premises, in marketing materials and in the finance agreement itself. Finally, there are other factors influencing the headline reduction in overall redress. An increase in the average of payout of £829, up from £695 in the original consultation proposals, is, however, the likely outcome. Without rehearsing those additional reasons exhaustively, they include some rebuttals to the presumption of unfairness in certain cases, where there's a relevant arrangement, some operational changes and changes to redress. In respect of the latter point, changes to redress, redress will only be given in the amount of the commission where there is a very high commission, as defined, and an inadequately disclosed discretionary commission arrangement, as opposed to an inadequately disclosed tied arrangement, which was the consultation proposal. In all other cases, a hybrid remedy will be given, which includes a capped remedy alongside compensatory interest of at least 3%, and that interest rate is a rate at a minimum that consumers cannot challenge. Let's have a look now at some of the potential challenges to the scheme, and let's do so before you hear from Richard again on what it means to current claims. The challenges that I wish to highlight, there are two of them, if successful, may write another chapter in the saga that Richard outlined at the top of our presentation, and at the very least prompt further changes to at least one of the schemes. First, and without being too technical, it's worth noting that the schemes are consumer redress schemes under Section 404 of the Financial Services and Markets Act 2000. Section 404D of that Act makes provision for a review of any rules made under Section 404 by application to the upper tribunal. Process aside, though, on what grounds might the scheme be challenged in the upper tribunal? Well, the FCA itself recognises a fairly clear potential ground of challenge. In respect of running two schemes rather than one, it says this: in light of feedback, particularly raising the possibility of legal challenge to the application of the scheme to pre the 1st of April 2014 agreements, we have considered how best to protect the integrity, deliverability, and timely implementation of the scheme as a whole. Well, we remain satisfied that our powers permit us to introduce a scheme covering the full period. We recognise that a single scheme spanning both periods could face an elevated risk of legal challenge that might delay or disrupt delivery. Well, what is this getting at? The answer is the fact that by Section 404E of the 2000 Act, the schemes apply to consumers who have used services provided by authorised persons in carrying on regulated activities. But consumer credit was not an activity regulated by the FCA until 2014. John Swift KC was the rail regulator between 1993 and 1998, and is the author of the 2021 Swift report on the FCA's conduct in respect of interest rate hedging products. He wrote in the Times on the 5th of April that the question is why the FCA considers it can make a scheme in respect of pre-April 2014 credit agreements in these circumstances. He argues that on a plain reading of the 2000 Act, there does not appear to be a statutory basis for the first scheme, which covers pre-2014 agreements. This question has gone unanswered in the FCA's policy statement. A second potential challenge, to which I will refer briefly in the interest of time, is to the way in which the FCA deals with the issue of limitation in Chapter 4 of its policy statement. To the extent that the Supreme Court's recent judgment in THG plc and Zedra Trust Company Jersey Limited is applicable to claims under Section 140A of the Consumer Credit Act, it is not reflected in the FCA's guidance on limitation in relation to agreements where there is only a high commission arrangement. This is another area that may be subject to further review should a challenge be made. Well, from the upper tribunal to the county court, what does all of this mean for claims that have already been issued, Richard?
Thank you, Jack. Well, the deadline to submit a formal scheme implementation falls quite soon. The deadlines are going to come pretty quickly after that. Scheme 2, the post-2014 part, officially begins at the end of June this year. So this is going to get underway pretty quickly. As to how finance will be sold going forward, we don't see major changes. DCAs went out of existence 5 years ago, and disclosure by dealers has already been beefed up after the Court of Appeal's decision in Johnson. There may be a few further tweaks, we think, to avoid the high commission definition in the scheme in particular, in other words, the 39%, 10% definition. But apart from that, little may change on the forecourt, as it were. There are still a large number of county court claims which are already on foot, and many of those are currently stayed. Decisions will have to be made about those quite soon, because claimants have typically entered into retainers with their solicitors. They usually cannot simply terminate the arrangement with their solicitor and end the claim, go into the scheme. They would then have to face a bill for all the work that's been done. So it's largely up to the claimant law firms. Do they want to continue with these claims? And we think that a lot will turn on track allocation. Claims which are close to a fast-track trial may well continue because those are cost-sparing claims. But many claims are being reallocated to the small claims track or are already there. We're sadly not really privy to the financial side of claimant litigation, but we would ask ourselves, surely these claims are not going to make a great deal of money for those who run them. Another question which arises, will those who fall into one of the exceptions from the scheme move towards litigation instead? Or is the county court litigation currently about working through already issued claims? It is possible that a significant number of claimants do not go into the scheme. Firstly, we have the de minimis cohort, in other words, those under £150 or £120, but it's difficult to see claims management companies trying to take these to the county courts, given the very limited recovery and indeed the low chances of convincing a judge that there was in fact unfairness. Individual consumers could go to the Financial Ombudsman Service, but we think that would be a small number. Then there are pre-2020 cases. There is a concession in the scheme. Firms can exclude pre-2020 High Commission cases if the fact of the commission was prominently disclosed, even if the amount wasn't. There are nil redress cap cases for those in the top 5 percentiles. They might receive zero redress even if disclosure was poor. This is apparently a fairness check to prevent consumers who got a great deal from profiting further. There is another potential major exception. If there is a successful JR, or I should say a challenge to the tribunal of the scheme, then cases, particularly the older cases from 2007 to 2014, could be back in the county court. And there are other visible links cases. Those consumers might not get redress under the scheme. They might try to take their cases to the county court. But we think they'll all face the same problem, which is that the defendants can simply point to the FCA scheme and say the FCA does not see unfairness here. So that's the county court litigation. Then there is also High Court litigation. Many of you will be familiar with the litigation in the Angel case involving an omnibus claim form. And claimant firms might take the view that whilst they are earning little per claimant in the county court, and indeed paying a lot in costs, which is not remunerative, grouping claimants together and taking them to the multi-track makes much more sense in future. The issue there might well be that there is delay and there is complication. Taking group actions forward is not straightforward. We should find out soon what the future of omnibus claims is, because Angel is going to the Court of Appeal in late April. And indeed, there have been a number of other omnibus claims issued recently. We understand that most of those have been stayed behind Angel. So there is county court litigation and there is High Court litigation. In terms of what else is coming up, we have a racing certainty that there's going to be significant developments over the next few months in terms of finding redress one way or another for those who are already litigating the issue. With that, I'll hand back to Jack to tie things up for us. Thank you.
Thanks very much, Richard, and thanks to all of you for joining us this morning for Gough Square Live. The next episode of Gough Square Live features Cameron Crowe KC and Robin Kingham. They will be presenting on the 5th of May, so be sure to tune into that too. That's it for now. Thanks very much.